You're operating in finance, insurance, or enterprise risk management today, there's this massive strategic risk multiplier. Its name, climate change.
Right. It's really shifted, hasn't it? It's not some abstract environmental thing anymore.
No, definitely not. It's immediate, it's intense, and it's actively shaping asset prices, underwriting decisions, capital strategy right across the global economy.
And that's really the core of the materials you shared with us. They lay out this whole new way we have to think about quantifying and managing these climate-related financial exposures.
Exactly. So our aim here is to, well, cut through that complexity, give you a clear, structured handle on the risks themselves, the specific ways they cause financial damage, and crucially, the tools and regulatory changes emerging.
We want to make sense of it all.
And just a quick note for those of you using this analysis professionally, if you engage with this discussion and complete the knowledge quiz that comes with it, you can earn valuable continuing professional development points, CPD points.
Yeah, that's important for many people in finance, insurance, risk management.
Think of this as maybe the essential briefing on integrating climate risk into your strategy.
Okay.
So let's unpack this. We should probably start by clarifying the risk categories, but focusing on their financial teeth.
Yes, how they bite.
Then look at the pathways, how these threats actually cause real financial harm. And finish up with the strategies, the resilience tools, and what regulators are demanding.
Sounds like a plan. So, starting with the risks, most people know the basic labels: physical, transition, and liability.
Right.
But the real key, the thing we need to focus on, is how each one actually hits the bottom line, the balance sheet.
Let's dig into physical risks first then.
Yeah.
We hear a lot about acute risks, those sudden shocks, hurricanes, wildfires,
Big immediate damage, huge insurance claims. Very visible.
But maybe the trickier part is the chronic risks, the slow burn stuff.
Ah, yes.
Yeah,
Chronic risks are, well, they're insidious. They don't make headlines in the same way.
like sea levels creeping up, or just higher average temperatures year after year.
Exactly. Persistent drought is another one. And financially, what does that mean? It means a slow, relentless wearing away of asset value. Think about collateral quality for, say, real estate portfolios.
Over time, it just degrades.
It just degrades. It doesn't cause one big shock, maybe, but it erodes the fundamental viability of assets permanently.
Okay, then we have transition risks. This isn't about the weather itself, is it?
No, this is about the response to climate change. Policy, regulation, technology shifts, market sentiment, all moving towards a low-carbon economy.
So like a government suddenly brings in a hefty carbon price.
Yeah,
Or maybe forces coal plants to shut down faster than expected.
precisely. And that creates huge financial exposures very quickly sometimes.
Yeah.
This is where that term stranded assets becomes a real headache for capital planning.
Right, assets that just lose their value way ahead of schedule.
Yeah, imagine a gas pipeline or maybe a coal-fired power station built to last decades. But suddenly, because of policy changes or because cleaner tech gets cheaper faster, it's basically obsolete, worthless, long before its time.
And that forces businesses to rethink everything. What might have been a 10-year investment plan suddenly needs reviewing in, 18 months?
It compresses those cycles dramatically, which makes these transition risks, in some ways, even harder to model than, say, a flood.
Because it's about politics, about market psychology, and not just physics.
Exactly right. And the third category, liability risks. This is the legal front.
Getting sued.
Basically, yes. Companies are increasingly facing lawsuits for, well, a couple of main reasons. One is failing to properly mitigate climate risks that then cause damage.
Okay.
But the other, and this is huge now, is misleading investors or the public about their actual climate exposures. Greenwashing litigation is a growing area.
So due diligence isn't enough anymore. It's about transparent disclosure.
Disclosure is absolutely critical. It's the new battleground globally.
Okay, so we got the three big buckets: physical, transition, liability. But how do these abstract threats, translate into actual financial damage for institutions? The materials lay out 5 key pathways.
Yes, and they often interact, feeding into each other. The first is maybe the most obvious: asset impairment.
The direct hit.
The direct hit.
Yeah.
Physical assets get damaged or just lose value. Think of, say, a coastal hotel chain suddenly facing massive flood risk. Its valuation drops, insurance premiums might skyrocket, or maybe they can't even get coverage anymore.
Right, and that leads into the second pathway, doesn't it? Credit risk.
Absolutely. This is where that interconnectedness really shows up. If your borrowers could be companies, could be individuals or in vulnerable sectors, their finances get shaky.
Like a farming business hit by repeated droughts.
Perfect example. They're much more likely to struggle repaying loans. Default risk goes up.
And that doesn't just stay with that one loan, does it? It ripples outwards.
It ripples. Think about maybe a regional water utility struggling because of long-term drought. Their revenues are hit. That could potentially impact the ratings on municipal bonds linked to that utility.
Ah, okay, so it climbs up the financial structure.
Exactly. Systemic risk starting from a localized physical impact.
Then pathway number 3, market risk, the volatility piece.
Right. Climate shocks don't just damage property, they shake up markets. Prices become unstable.
Like a heat wave hitting crop yields somewhere, and suddenly commodity prices spike globally.
Or a sudden policy announcement about emissions targets sending ripples through equity markets or bond markets. It can cause unexpected large trading losses.
Number 4 is operational risk. Day-to-day business getting disrupted.
Yeah, this is about keeping the lights on, literally sometimes. Extreme weather can just stop operations, damage IT systems, prevent staff from getting to work.
And that immediately hits costs, hits earnings.
Instantly. Increases operating expenses, throws forecasts off track.
And finally, pathway 5, reputational risk.
This one can be harder to pin down up front, but the impact can be devastating. A company seen as failing to address climate risks, or worse, caught hiding them.
Investor backlash, consumer boycotts, big regulatory fines.
All of the above. Loss of trust is hard to quantify, but it quickly translates into a higher cost of capital, maybe difficulties attracting talent, and potentially serious damage to the company's market value.
To really bring this home, the numbers are just stark. Hurricane Katrina back in 2005, over $125 billion in damages.
And that wasn't just an insurance payout number. That event forced a fundamental rethink in the industry. It changed catastrophe modeling forever, changed where capital felt safe going.
A complete reevaluation, practically overnight.
Mm-hmm.
And then you look at the Australian bushfires in 2019-20, or those terrible European floods in 2021.
They really highlighted another critical failure point, the insurance protection gap.
Explain that gap.
It's the massive difference between the total economic losses from a disaster and the amount that was actually insured.
And that gap is widening.
It's widening fast. It's basically a market failure. Climate uncertainty is making it so hard or so expensive for insurers to price the risk accurately that they're pulling back coverage from the highest risk areas.
Leaving governments, businesses, individuals holding all that risk themselves.
Exactly. Unmanageable risk in many cases. That's the intense pressure point, especially for the insurance sector right now.
Speaking of insurance, they really are on the front line here, aren't they, as the main mechanism we have for managing and transferring risk.
Absolutely.
Yeah.
And the stats show the strain. Global insured losses from natural catastrophes. They've more than doubled in the last couple of decades, routinely topping $100 billion a year now.
That kind of volatility,
Okay.
it must break the old models.
It does. That's the core challenge. Traditional actuarial models, they work by looking backward. They rely on historical data to predict future losses.
But if the climate itself is changing rapidly,
Then the past becomes useless.
yeah.
Worse than useless, it's misleading. That 1 in 100-year flood people talked about, maybe it's now a 1 in 20 or even 1 in 10-year event in some places. Historical data just doesn't capture that shift.
So what are they doing? They have to innovate, surely.
They absolutely have to, and they are. They're augmenting the old models with forward-looking tools, bringing in climate science data, running sophisticated catastrophe models based on future climate scenarios.
Using things like high-res mapping, GIS data.
Yes, geographic information systems, GIS mapping, to understand vulnerability street by street almost. You simply cannot rely on historical averages anymore if you want to remain solvent.
And regulators are pushing this hard.
Very hard. The Task Force on Climate-Related Financial Disclosures, TCFD, that framework is now pretty much the global benchmark.
Forcing companies to be transparent about how they handle climate risk across, 4 areas.
4 pillars. Governance, who's overseeing this. Strategy, how does it affect our business? Risk management, how do we identify and manage it? And metrics and targets, how do we measure exposure and progress?
And we're seeing this convergence globally now, which is important given how connected everything is. The new IFRS S2 standard.
Yes, from the International Sustainability Standards Board, the ISSB, that's a big step. It's consolidating global reporting requirements, pushing climate disclosure right into mainstream financial reporting.
So it's not just a separate sustainability report anymore. It's part of the core financials.
Exactly. And then you have powerful regulators like the PRA in the UK or under Solvency II in the EU explicitly mandating climate scenario analysis, making sure banks and insurers stress test their balance sheets against future climate shocks, embedding it deep into risk management.
Okay, so this regulatory pressure means shifting gears, moving from just assessing risk to proactively managing it.
Right. And the key strategic tool for that shift is scenario analysis and stress testing. You have to look forward.
Assessing how the organization would hold up under different possible climate futures.
Precisely. Using different assumptions about how quickly policy changes, how much warming we see, how fast technology evolves, it moves you beyond relying on that unreliable past data.
And there are standardized scenarios regulators are using now, aren't there? From the NGFS.
Yes, the Network for Greening the Financial System. They've developed 3 core scenarios that are becoming the benchmark globally.
What are they?
There's the orderly transition that assumes we take early, coordinated action globally. Then the disorderly transition action comes late, it's sudden, disruptive, probably more painful economically in the short term.
That sounds like the one that could cause the most immediate financial shock, doesn't it? The disorderly one.
Yeah.
A sudden policy shift catching markets off guard.
It certainly represents a major short-term threat to valuations, yes. Especially if policy or consumer behavior shifts abruptly before companies have fully adapted their capital plans.
And the third NGFS scenario.
That's the grim one. The hothouse world, where we basically fail to take sufficient action and end up with severe physical climate impacts. Runaway warming.
Okay, so scenario analysis is key. What other tools are emerging? You mentioned data earlier.
Yes, innovative data is crucial. We're seeing much more use of high-resolution geospatial data, satellite imagery.
To pinpoint risks very specifically, like this particular coastline or this specific forest area.
Exactly. Location-specific vulnerability assessment. And alongside that, AI and machine learning are becoming essential.
Why AI?
To help find the patterns, the nonlinear trends, the early warning signals hidden within these massive, complex climate datasets, humans struggle to process that scale of information effectively.
And all of this, climate risk, it's now firmly embedded within the ESG framework, right? Environmental, social, governance.
Absolutely. It's a core part of the EA, and that's really driven the explosion in green finance.
You mean things like green bonds?
Green bonds to fund specific environmental projects, yes, but also, perhaps more interestingly, things like sustainability-linked loans and bonds.
Where the interest rate changes based on performance.
Exactly. The borrowing cost is directly tied to the company achieving specific, measurable climate targets, KPIs. It creates a real financial incentive to decarbonize.
There's also transition finance, helping the big emitters change.
Yes, providing capital specifically to support those carbon-intensive industries. Think steel, cement, heavy transport on their necessary, but often gradual journey towards lower emissions. It acknowledges that not everyone can flip a switch overnight.
Going back to insurance for a moment, you mentioned the protection gap. Are there innovations trying to close that?
Yes, definitely. One of the most promising is parametric insurance.
How does that work differently?
It's fundamentally different because it bypasses the traditional loss assessment process, which can take ages.
Right, waiting for adjusters to assess the damage.
Instead, parametric policies pay out automatically and quickly based on a pre-agreed trigger event being met. Like wind speeds reaching a certain level recorded at a specific weather station, or rainfall exceeding a certain threshold, or an earthquake hitting a specific magnitude.
So it's based on the event itself, not the measured damage. Faster payouts.
Much faster, more transparent. Which is crucial for immediate relief and resilience, especially in developing countries that might lack sophisticated loss adjustment infrastructure.
Are there other mechanisms?
We're also seeing the growth of climate risk pools.
Yeah.
Things like the Caribbean Catastrophe Risk Insurance Facility, CCRIF, or similar initiatives in Africa and the Pacific. These are regional risk-sharing schemes where countries pool their risk together to get more affordable cover.
Okay, so zooming out from just finance and insurance, this needs to be integrated across every company, right, into their overall risk management.
Absolutely. It has to be part of the enterprise risk management, the ERM framework. It can't be siloed off in a sustainability department.
And that means the board needs to be involved. proper oversight from the top.
Genuine board oversight is critical, and organizations need to do proper materiality
Do
assessments,
you mean?
meaning figuring out which specific climate risks, physical, transition, liability are actually most relevant and impactful for their particular business, based on their geography, their industry, their supply chain. It's not one size fits all.
And that can be politically tough internally, I guess. Getting buy-in when climate risk feels long-term compared to immediate market pressures.
That's often the challenge, yes. Balancing short-term demands with long-term strategic resilience.
So despite all this progress, the frameworks, the tools, the awareness there are still significant hurdles, aren't there? What are the main gaps?
I'd say there are three main persistent challenges. First, data and modeling limitations. We still don't have enough reliable, granular, easily comparable data, especially forward-looking data.
Making it hard to translate the science into clear financial metrics that satisfy regulators and investors.
Exactly. And developing standardized methodologies that everyone trusts is still a work in progress.
Okay, gap number one, data and models. What's two?
Second is the patchwork global regulatory landscape. While there's convergence towards TCFD and IFRS S2, there are still lots of national variations and differing timelines.
Which creates headaches for multinational companies trying to report consistently.
Huge headaches. Reporting fatigue is real, and it makes it harder for investors to compare companies across different jurisdictions.
And the third big challenge,
This might be the biggest. The skills and capacity gap.
not enough people who understand this stuff.
Not enough professionals who can comfortably bridge the gap between climate science, complex data analysis, and financial risk management. We need people fluent in all those languages. There's a real shortage.
So upskilling existing teams, bringing in new talent with those blended skills,
Wait,
that's a strategic priority now.
it absolutely has to be.
Okay, so let's try and wrap this up. The final takeaway here. It feels like, yes, the risks are huge, they're complex, potentially very expensive.
Undeniably.
But there's also this flip side, isn't there? Opportunity.
Immense opportunity, actually, for the companies that get ahead of this. The first movers in developing resilient infrastructure, creating green technologies, offering sophisticated climate advisory services.
They're positioning themselves for a real competitive advantage.
Definitely. This isn't just about managing downside risk or ticking regulatory boxes. It's also about spotting the upside, driving innovation, and ultimately creating long-term value.
So climate risk isn't just another risk category. It's a multiplier. It touches everything: legal, operations, reputation, strategy.
It really does. And you, the professionals listening in finance and risk and insurance, you're the ones who are crucial in helping organizations navigate this complexity. You're at the intersection.
Which leads us to a final thought, something for you to maybe mull over after this.
Mm-hmm.
Ask yourself, how effectively, really, is your organization translating the scientific uncertainty around climate change into financially meaningful metrics? Metrics that are actually driving investment decisions and strategic choices today.
That's the critical question. Thank you again for sharing these materials with us. We really do encourage you to explore the resources further. And don't forget that quiz if you're looking for those CPD points.